In today's video, we are going to look at a case study where someone is interested in using a whole life insurance policy set up for maximum cash value to purchase a piece of real estate. So in this specific example, the piece of property they are considering is valued at $370,000, and they are in a position where they can acquire the property in cash. Now they're looking at financing the property with a bank where the interest rate is fixed at 5%. We're shooting this video as of October 2022. So a fixed rate of 5% is not bad at all. However, they're looking at that property and thinking, okay, I'm beginning to understand how cash value life insurance works. On a whole life insurance policy, the loan interest rate is right around 5%. So should I use the bank or should I use my policy? Does it make sense for me to take out a whole life insurance policy, stuff it with a large lump sum so I've got the ability to immediately acquire the property by taking a loan against my policy? And the answer to that is maybe, but we really have to look at that first year, because what are the worst years of any whole life insurance policy? Or I should say, what is the worst year? It's always the first year, no matter how well it is designed. So the details on this particular case are as follows. We've got a 50-year-old female, and they've got about $500,000 sitting in cash right now, just money in the bank. Now, in order to fund a policy, they made it very, very clear just on the last phone call I had with them that they do want to be able to pay off that property immediately, or they would like to see what that looks like, because I did recommend at least looking at some alternatives to the strategy they had in mind, which gives them more money in the long run and in the short term too, when you see it, short term being a couple years. But the strategy is as follows: a $450,000 lump sum going into a policy, and then continuously funding the policy after that lump sum with $100,000 per year through the age of 65. She's starting at the age of 50. So age 50 to 65 is how long? 15 years. Now, we had originally looked at a 10-pay policy, which will accept payments for 10 years, but she wasn't really into that. She did mention that she probably wants to fund the policy longer than 10 years. So I asked her the question, would you want to fund longer than 15 years? I won't hold you to it, but just where you're at right now, do you think you might want to go longer than 15 years? There's a pause, and then probably not. The reason why I asked that question is because she was primarily interested, or is primarily interested at this point in time, in MassMutual. And if you look at MassMutual's products that are designed for high cash value, they've got a lot of products, but their 10-pay policy and also their 15-pay policy have lower PUA fees, and you'll see the strongest internal rates of return when you look at the cash value in those products compared to other products they offer. Their other products are great if you want to fund a policy longer than 10 or 15 years. But the reason I asked that question is because you've got two products with lower PUA fees than all of the other products with MassMutual at this time, the time of shooting this video. So the 15-pay is a good option. We're still looking at the 10-pay product, but in this example, we're going to look at $450,000 paid into the policy with an initial lump sum, which will give her the cash value to be able to purchase that piece of property for $370,000, and then $100K per year for the next 14 years, up until the age of 65. Now, flexibility is important. Not so much having the flexibility to commit to a minimum amount and then pour in excess PUAs at leisure, like what a guardian would provide, but more so the flexibility to adjust the total dollar amount she pays in each year. So this, she knows she can pay into the policy in the first year because she has the cash on hand. The $100K the second year, no problem. However, as the years pass, her income has fluctuated over time. What happens if she has a down year and is not comfortable paying in the full $100,000? Well, she could easily get away with zero if she starts out with a lump sum of this amount and pays $100K for the second and third year. She could pay zero. She'll be able to pay something, or at least she's confident she can. But what if she can't do 100? What does a policy look like if you only fund $50K per year? Or what does a policy look like if you want to stop funding early? I know right now, as we're discussing the policy, we're looking at funding a policy for 15 years. But what happens if life happens and I can't pay, or I just change my mind and I want to stop after 5 years. We see this quite a bit. Not all the time, but we work with a lot of individuals who start a policy with plans of paying into it for a long period of time, but then they want to stop early because they see a stronger internal rate of return. Their financial situation has changed, whatever it might be. We want to make sure the policy is set up with these options so I can pivot with the funding as the years pass. Because the purpose of this video is to look at purchasing this property. However, where this plan is going to blow up, or I should say where people are often upset with their whole life insurance products after the fact, or at least where we have heard people express frustration, is almost always with the funding. Wanting to be able to adjust the funding, have richer cash value up front, richer cash value in the guarantees long term, everything that comes with maximizing the cash value. So how do you maximize the cash value? That's the question first, because if you maximize the cash value or maximize the growth first, as we have up on the board, what does that do for you if you're looking to leverage the policy? If this is you, if you maximize your cash value first, you'll have more cash value, which means if you want to use the property to purchase a home, or if you want to purchase more real estate in the future, if you've got more cash value, you've got more money to work with, which allows you to acquire more. You can move faster. A lot of individuals who have an entrepreneurial mindset or business owners value that more than anything else. They view the cash value life insurance product as a good asset to position money that usually sits in cash. Now they actually see it grow. It's safe, it's liquid, it's tax-free. Tax-free if we don't trigger a MEC or another taxable event, but they actually see it go to work for them, and that's where the attraction is. So maximizing the growth first. Here's what I want to hit on here because this is very important, and then we're going to look at the loan analysis. So strategy or the original plan is what? $450K in the first year, and then $100K per year, years 2 through 15, which gets total deposits into that policy of $1.85 million in this illustration. But then we're going to look at option B, which is the exact same product, exact same company, a Mass Mutual 15 pay. But what we'll look at here is the same total deposits of $1.85 million. But what we'll look at is breaking that lump sum up over 2 payments. We'll look at $225,000 in the first and second year, then $200,000 in year 3, and then $100K per year, years 4 through 15. So it's going to be the exact same out-of-pocket, but the question is, which one produces you, as the policyholder, greater cash value short-term, long-term, and also greater death benefit long-term, if the death benefit's of concern to you? What we'll begin with here is option A. And what we've got is as follows. We see what? Option A, funding, annual outlay, $450,000 in the first year. The breakdown as to where this money is going, we've got a base premium of exactly $45,000. Then we've got a term rider attached. We've actually got 2 term riders attached in this example, and then we're plowing everything else into PUAs. How's that cash value look in the first year? That's pretty good, $400,000. Now, pretty good is relative to your knowledge on whole life insurance. If you're new to this, that looks pretty bad, because if I'm new to this, I would say, what do you mean that looks good? It's a $50,000 hit. $50,000 is a lot of money. If you've ever seen traditional whole life insurance policies, you know that is fantastic, because a traditional policy would give us 0. The name of the game is, how do I reduce the insurance premium, the expenses, as much as I can, which allows me to direct more money into the PUA rider, which stands for paid up additions, and this is the key to maximizing the cash value growth. The death benefit, $6.5 million and change, gives her a MEC limit, that taxable line, of guess how much? $450,000. So how we came up with this wacky death benefit is that is the minimum death benefit needed in order to pay in up to $450,000 per year without triggering a taxable event. Remember that an individual's age and total death benefit have a direct relationship to the MEC limit. If you'd like to understand more about the MEC limit and how it works, I would check out one of our MEC limit videos. We've got one in the top corner of the screen. So as we look at this guy, 450 in the first year. Next year, year 2, 100 goes in. Do you get your full 100 back? No. This example is easy because I'm at 400,000. If I add 100,000 to it, I would be at 500,000, but I'm at just about 492. So no matter how I slice this, I've got about an $8,000 loss in year 2. How about in the next year? I pay in 100K. The full 100K back would result in the value being 591, but I get another 10K back on top of it. So now it's starting to pick up the pace. What's highlighted in yellow represents the break-even point. This is when I have equal value in cash value relative to what I've paid into the product or more. So for example, year 6, your total output is $950,000 and your total cash value is $963,000. So we have a gain on the policy in this particular case based on the illustration and the present dividend interest rate. And then we keep on funding it. By age 65, I've paid in 185 and I've got $2.5 million in cash value. You'll notice a lower death benefit because we cut the term rider after the first 7 years without triggering a MEC in this particular case. So that's option A. Let's look at option B. What we've got here, Mass Mutual 15 pay, same out of pocket. What do we notice here? Let's begin with the first year. So first year, 225 goes in, 199 in cash value. You've paid in a total of 225. So this on the far right in purple, CV stands for cash value difference, represents how much less or how much more I have in cash value with option B compared to option A. So I have less in the first 2 years because less has gone into the product at this point in time. By the second year, another payment of 225. I've got 450 in, whereas option A, you've got 550 paid into the product at this point in time. However, by year 3, here we're paying $200,000. Total input, 650. And what do you have here? 623. How about over here? You're at 601. So same exact product, $22,000 more in cash value. The reason why is because here, this 225 going in, guess what the base premium is? What was in this example? 450 going in, the premium was 45K with option A, and I 10x'd it in the first year. In this example, it's 22.5. Same 10% of the total payment. However, we're 10xing it the first and second year. So if we redline a policy, 10x the base premium up to the MEC limit for 2 consecutive years, that puts you in a fantastic position where we see the break-even point here. Between years 4 and 5, it's close to year 4 when you look at those numbers there. Positive by year 5 in this example. Even if the dividend comes down quite a bit, we should still see a break-even point of year 5. It's attractive when I look at the value there. Now, as I look at everything through year 15, what do I notice here? I've got more cash value there from start to finish of the funding period. Let me show you something though. Let's scroll down a bit here. And what do you notice? What starts to happen? Interesting, right? Same product, same dividend rate. Here, I see the initial lump sum option generate higher cash value. The example where we spread the payments out begins to fall behind. Why is that? The reason why is because option A has a higher base premium, and how the dividends are applied to the base premium dollars are more favorable than PUAs. So based on this illustration, option A is more attractive. Based on this illustration, option A is more attractive. Would I personally do option A? I have a hard time with it. And why I say that is because the illustration might show things looking better, but based on reality, actual policies we've seen that have lived the test of time, I know in this guy, when I look at a conservative dividend, when I look at the guarantees, it's more attractive. if I were to reduce funding, here's option A and option B. Option A on the left, same thing with that one-time lump sum. And then over here, we spread it out. So what we did was cut the funding down to $50,000 beginning the second year. And over here, there's the $450,000, but then $250K payments in year 3, which gets your total output to $550,000. What do you notice here? Well, first, what do you notice with the break even? The example where we maxed it out in the first 2 years still breaks even between 4 and 5. The example with just the one-time lump sum, just about year 6, but it's between years 6 and 7. How about that cash value difference column? Different story this time, isn't it? Very interesting. What happens if you stop funding early? So here we go, $450,000 year 1, followed by $100K years 2 through 5, and then same thing here, same out of pocket, but stopping funding after year 5, $225,000, $225,000, $200,000, and then $100,000 for 2 more years. What do we see? The example where I spread the lump sum out gives me more money from start to finish. Interesting, isn't it? So option B is definitely a safer route to take if you like to look at things conservative. What I'll also add is if we were to look at the guaranteed values, it's stronger there. Can go with either option. A lot of times, not a lot of times, but sometimes we'll work with individuals that might select option A with the larger lump sum going into the policy because they view it as an opportunity cost. Maybe they want to be able to borrow the full amount to purchase a $370,000 home immediately. If I've got $400,000 in cash value, which I saw in that last example, or in option A, I should say. So let's go back to this. $450,000 in, $400,000 in cash value. How much can you typically loan against a life insurance policy? Generally speaking, about 95% of whatever you have in cash value, which would be what? Be about $380,000. So you can access the full $370,000 within the first year, no problem. Over here, you wouldn't be able to. So that might be a case where she goes with option A. If she pays more than $100K during some years, because her income does get very high at times, option A could make sense. But if we flip positions, and I'm you, but I know what I know just being in the business, I want to know about this up front, or just have the awareness to know where are the potential pitfalls, the unseen elements here, where I don't want an agent, someone like me, just to say, hey, look at this, option A, you actually end up with more money long-term in this example. Therefore, I sell you this policy and I make a significantly higher commission because the base premium is almost double. It is double compared to option B. So it comes very close to doubling my commission. It's like, okay, should I do that? I don't know, because if I'm you, I'd want that. So I'm going to show both options. It's ultimately up to the consumer, but personally, I'm more comfortable with option B. So a lot of information right there to lead up to a loan analysis, because we want to look at purchasing the property. Why I do that, why I spend all that time, is because the most important thing is everything we just covered there. The loan analysis part is pretty easy as we start to look at that. So getting this right, selecting the right option, is often what puts people in the best possible position where they're happy with the policy and can use it to the fullest. Now, let's take a look at the loan analysis here. We're going to look at both option A and option B. What are the advantages here? Starting with option A, what do you have? Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.